Assalamu alaikum everyone. The topic I'm going to cover today is banks income, myths and reality. So the focus over here is to go through a number of statements and discuss whether those statements are true or false. So going to the statements. Okay. The first statement is the net interest margin, net interest income is driven by lending, interest earning assets volume, and the net yield available on these assets after taking into account the cost of funding. This is the precise definition of net interest income, which is the cost, which is the return on loan assets minus the cost of the loan, cost of all the deposits that the bank have. Now, if the loan assets, the interest earning loan assets are more, if the volume of those assets is higher, then definitely the bank will get more income. And similarly, higher this will increase income. Similarly, if the bank has more net yield, so you can think of this as the price, net yield as the price, and earnings volume as the quantity. As both of these increases, your revenue, which is the net interest income, will also increase. So this statement is true. The second statement, while the main focus of the banks is on the loan book, the ALM desk, ALM is Asset Liability Management Desk, will also concentrate on the bank's investment portfolio. The latter will include coupon receipts from money markets and bond market assets, as well as dividends. Yes, any form of income that the bank gets, be it from the trading side, would be important to match the assets and the liabilities of the bank. Because of the timing difference between short-term liabilities and long-term assets, it is entirely very, very important for the bank to match all the incomes. So yes, this statement again is true. Now moving on to the third statement. Okay. For a retail bank, the most expensive source of funds is deposits, and the most expensive, especially non-interest paying deposits such as check accounts. This statement is clearly true. This is the least expensive, almost free source. So what we have over here is the least expensive free source funds which a bank could have. So this statement is definitely false. Okay, statement 4. Even in the era of high street competition means there are a number of banks who are competing with each other. The interest payable on the short-term liabilities, such as instant excess deposits, is far below the wholesale market interest rate. Yes, that's again true. When the bank gets deposits, such as in form of short-term deposits, short-term saving accounts, this rate is still less than the market interest rate, because banks give a low premium to their clients in terms for most short-term saving accounts. So this statement is true. The fifth statement, the cheap deposits and low interest short-term liabilities are funding advantage for investment banks when compared with retail banks, which generally do not have a deposit base. Okay, there is definitely a problem over here. Retail banks have a deposit base. Investment banks do not have a deposit base. So these two words have been interchanged over here. Investment banks do not have a deposit base. Retail banks do have a deposit base. So this statement is false. Oh. Moving on to the next statement. Other funding sources for bank include capital market, so they can have senior level debts, wholesale markets, the interbank money market, the securitized markets, and the covered bonds. Yes, bank can raise money from all these sources. They can issue senior debts. They can trade in the interbank markets, the wholesale market. They can have uh, securitize instruments, and they can also issue covered bonds. So this statement is totally true. The next statement, the overall composition of funding do not significantly affect the net interest margin, and if constrained can reduce the activities of the bank. Uh, from the start, we can see this statement is incorrect. If your funding goes down, then your margin will go down. You cannot create as many loan assets. If you cannot create the same number of loan assets, then your number of loan uh, revenue, the fees, interest fees revenue will go down, and therefore your banking activities will also be impacted. So this statement is definitely false. The answer should have been it does impact your, if your overall composition of funding goes it gets worsened, then your interest margin would be affected and your activities will be affected. Okay. H point. The risk profile of asset classes that generate yield for the bank should lead to a range of net interest margins being reported across the sector, such as the bank with a strong unsecured lending franchise should seek significantly higher yield than one investing in secured mortgage loans. This reflects the different risk profiles or assets. This statement is true. This is same simple risk reward theory. So higher the risk you take, the more reward you want. And that is true for the banks. If they invest in unsecured lending assets, they will they want higher return. So across asset classes, their yield is not same. This statement is definitely true. The proportion of non-interest bearing liabilities will also have a significant impact on net interest margin. If you have a non-interest bearing liability, you do not have to pay interest on it, and thus your cost reduces. When your cost reduces, your net margin increases. So this statement is true, definitely true. Okay, statement J. While a high net margin is desirable, it should also be adequate return for risk incurred in holding the assets. Now, this statement is pointing towards NPV. A high return is important, but if you're not generating positive NPV, you should not be holding this asset. So the statement is definitely true. Statement K, bank net interest income is not sensitive to both credit risk and market risk. The interest income is sensitive to both credit risk as well as market risk. If your market is moving quickly and you're making losses in your uh, assets portfolio, a loan portfolio, your net interest income would go down. On the other hand, if your credit risk increases, your clients start defaulting, again, your net interest income will go down. So this statement is definitely incorrect. Health statement. Interest income is sensitive to changes in the interest rate, but not the maturity profile of the company, of the balance sheet. So the statement again have one issue. Yes, interest income is sensitive to changes in interest rate. As the prices change, your interest income would go down. But also with regards to the maturity profile, if your more securities get mature, then you will face reinvestment risk, and there's a chance that you will have issues of uh, getting the same interest income in the future. So yes, the statement is false. Banks that have assets that mature earlier than their funding liabilities will gain from an environment of rising interest rates. So this is interesting. If your assets mature earlier, that means that you will be getting money before and you have to pay at a later point in time. You will get benefit from the increasing interest rate. So it's true. Banks, yes. Okay. And banks that have assets that mature later than their funding liabilities will lose from the gain in the interest rate. If your assets mature later, um, then you do not have the benefit of reinvesting at the higher rate. And if you cannot reinvest at the higher rate, you will lose out on these opportunities. So both these statements are true. While investment banks are less sensitive to changes in overall net interest income, due to their lower resilience on net interest income itself, their trading book will also be sensitive to changes in interest rate. Uh, this statement is true. It has three parts. The first part is that investment income is less sensitive to changes in overall net interest income. So investment income has a very small uh, relationship with net interest income. Uh, and then because investment banks do not rely on the banking side of the things. Their focus is on trading activities and not on the lending and loan asset generation activities. So because of the smaller component of such loan assets, their trading book will also be less sensitive to interest rate changes. Um, Less sensitive does not mean no sensitivity, because even though the volume is low, there the price risk is always involved. If the price goes up, if the interest rate goes up, the prices will be impacted. So this statement is true. Oh, T, fee income, known as in non-interest income, is separate from trading income and is desirable for bank because it represents a stable source of revenue that is not exposed to market risk. This is totally true. Fee income is independent of both trading income and your net interest income. This is focused on activities such as issuing cards, such as your locker services. In all these services, the bank gets revenue, which is more or less stable. Statement Q. Fee revenue is generated from sale and provision of financial services to customer. Precisely, this is what fee revenue do. You sell some services such as checkbook, cards, and you provide other services such as locker facilities. So this is true. In addition, an ability to provide fee-based financing may require insignificant investment in infrastructure and human resources. Because you're providing services, lockers need high level of infrastructure. Similarly, human resources needed when you provide or issue any type of cards or service. So insignificant over here is definitely incorrect. The correct answer over here is false. Higher the fee income represents lower diversification in bank's revenue base. Again, this statement is incorrect because the more fee income you have, the more diversification you will have. This should be higher diversification, not lower diversification. So this statement is false. If you have more fees income, you have a big chunk of stable income. And because you now have 2 or 3 sources of income, your diversification will increase. So the banks could benefit from having a stable fee income. Okay, the last 5, 6 MCQ, true and false. Customers' income is also attractive because commission income is also attractive because it provides an opportunity for the bank to cross-sell new products and services to existing customers. And provision of these services does not expose the bank to additional credit or market risk. Definitely, if you're getting anything by selling a service to your own customers, then you are getting a revenue with very little advertising, very little customer attraction cost. So this is definitely true. It will benefit the company bank in multiple ways. The level of fee and commissions are communicated in advance to the customer. Uh, yes, at the start of the year, a bank will notify the customers that these are the expected costs that they will have to bear if they take the bank services. So at the start of the year, yes, this is true. A record of consistent profit in trading over a long period is guarantee against the future losses arising out of market corrections or simply making the wrong bet on the financial markets. This is incorrect. Even if you have a record of consistent profits, it does not mean anything about the future. So there's no guarantee that if you have a long record of consistent profits, you will get future profits as well. So this statement, because of the nature of trading, is incorrect. Trading income arises from capital gains earned from buying and selling financial instruments. Yes, this is definitely true. This is a true statement. Trading income is the most stable form of bank revenue. Okay, this is the least stable form of bank revenue, so it is false. Trading income is the least stable form of bank's revenue. The most stable form is fees. The second most stable form is interest. And then you move on to the trading income. Trading instruments include both cash and derivative of balance sheet instruments and can arise from undertaking market making, which in theory is undertaking to meet client demands and proprietary business needs of the bank's own trading book. Yes, trading instruments includes the cash and derivative instruments because in the end you are going to trade anything against cash, and it may be arise because of market making where you are acting as the dealer and purchasing a security with the intention of selling it rather than keeping it for an investment. So this statement is definitely a true statement. Banking operating costs typically contains human resource costs together with operating costs such as premises, infrastructure, depreciation charge, and goodwill. Definitely true. All type of costs that you see in a corporate financial statement, you will also see in a banking financial statements. Cost is generally measured as a proportion of revenue. Again, that's true. In most successful businesses, your costs will always be less than the revenue. So this is technically true. So we have covered all these statements. In these statements, the idea was the bank has three types of income: the interest income, the fees income, the commission income. And from these three types of income, the bank generates a lot of activities. These incomes not only affect the profits, but they also affect the interest income in some way or the other. Thank you for watching. If you like the video, do subscribe and like.